Thanks for everybody for, oh, there we go. Thanks for everybody for attending the Lunch and Learn or Eat and Learn session on some tax tips. I'm going to walk you through over the next maybe half an hour, 20 minutes here, just kind of talk a little bit, some ideas I'd like to share with you just to kind of get the thoughts going. Now that tax season is behind us for some of us, if you haven't filed your tax return, you should be filing. It should have been filed. So it's really likely fresh in your mind now, and I thought that this was sort of timely to kind of just from an accounting point of view, because as most of you know, I'm an accountant. That some things that you can look at when you're looking at your tax return without being an accountant stuff, and some ideas just to kind of think about if you are concerned about your taxes and taxes owing. So let's go to the next slide. So this concept of average tax rate is really important, and I kind of talk about this through the whole session. And so when we look at average tax rates, and there's a bit of terminology that I'll walk you through today as well. But when we look at average tax rate, you have to understand, and you may already do understand, that the more money you make, the more taxes you pay. So what I'm trying to do here is kind of give you a sense as to the different levels of taxes. So at the very basic level, up to 57,375, it's 20.5% of taxes, which is your average tax rate. And that's comprised of two portions. There's the federal portion, and then there's the provincial portion. And of course, this is for Ontario. So the 57,375 is somewhat skewed a little bit from the federal and Ontario. So there are slight differences, but I kind of ignored them for our purposes. This gives you the sort of the concept. So beyond 57,375 up to 114, then you go from 20.5% average rate to 29.65, so almost 30%. So there's quite a bit of a jump there, right? But you have a lot to go because you're going from 57 to $114,000. So it's pretty significant amount of income increase, and you're paying an extra 10% on the taxes there at the average rate. So then beyond the 114, up to 177, then you jump yet again. Now you're not jumping quite 10%, you're jumping to, roughly 7 or 8% there. 37.16 would be your tax rate. So the concept is understanding where your taxable income, and we'll talk about what taxable income means, but understanding where your taxable income is and then what rate that you're at. And the key thing is trying to stay within a rate and or one way or another get into a lower rate, and that would create a refund for you of your taxes. And we'll talk a little bit about that as well. Next slide, please. So in calculating your average tax rate, so what a lot of people will say, and maybe you guys think about it the same way, if you look at the bottom page here, it often says taxes owing, right? And people come up to me and says, "Oh, I had to pay 5,000 in taxes, or I had to pay 10,000 in taxes, or 2,000 in taxes." So they're telling me the taxes owing. So taxes owing is defined as the taxes payable, which has been calculated based on your income, less which you have already remitted. So when someone tells me that they owe 5,000 in taxes, I says, okay, but what is like in terms of what was your taxes payable? What was your average tax rate? Like, if you tell me that you owe 5,000, it could be a number of different scenarios whereby your income was high, you didn't pay enough taxes through whatever, through your employer, or you had additional income. And so then you didn't make your remittances or installment payments. So that's why you're owing so much taxes at the end, especially a lot of the seniors that we deal with and stuff. They're always complaining about that aspect of paying, having to pay at year end. And I have them look at average tax rate. So the average tax rate is where you take the taxes payable, and I'll show you where to find that on your income tax return, divided by your taxable income. That will give you your average tax rate. So if you're in a 20% average tax rate or an 18% average tax rate, you're paying the lowest tax rate available to you. So regardless if I had to pay $5,000 of taxes owing, that's because I didn't make enough remittances or I didn't have enough taxes taken off my income or my pension. That's why I have taxes owing. But I am at the lowest tax rate, the average tax rate. And I think that's important to sort of understand. Your taxes payable are based on your income, less your deductions, times the tax rate, essentially, to simplify things. And we'll walk through an actual income tax return so that you can see exactly where I'm getting some of the figures. Next slide. All right, so here we go. So this is technically page 2 of your income tax. Back in the day when I used to do a lot of tax returns and the tax return was relatively simple. I think it was like 3 or 4 pages and that's it. Now it's pretty much like I think like 6 pages plus all the schedules that you have to do. So it is confusing for most. I find even myself when I'm looking at it, I got to double check to make sure that I'm on the right line and I'm looking at the right stuff. But some of the key things that you want to look at in your income tax return is starting at the income section. So the income section is all your total. Technically in Canada, all your worldly income has to be declared here in Canada if you're a Canadian resident and a Canadian citizen. So when people say, "Oh, this is I get a pension from Italy and stuff like that, and I'm not going to claim it," I say, "Nope." Technically, the CRA says all your worldly income has to be claimed there. Now, whether you pay taxes on that or not will determine between the tax treaties between our country and the other country, but you have to declare it here. So key thing everybody has typically will all have employment income. That's box 14 on your T4 slip. Very, very easy. So that would be your gross income. You'll see that on the T slip. And then some of the other incomes, I'm going to skip sort of all the pension stuff, but some of the other incomes that often we'll see on an income tax return at this stage is things like dividends. And so then you would have sort of investments, and the investments are doing well, and you're getting paid some form of a dividend for the investment. And then there is this thing about eligible and ineligible. Most of the time, it's non-eligible dividends that we have. And I'm not going to get into too much details because otherwise, then I have to certify you guys all as accountants then. And then no one's going to work at Jocelyn Insurance anymore. We're all going to be accountants. We're going to open up Jocelyn accounting practice maybe. Interest income is another one. That's line 10. So interest income, very, very simple. So that's, hey, I put some money in the bank, the savings account paid me a little bit of interest. You get a T5 slip for that. I should mention the dividends usually come on a T3 slip. Don't ask me why they had T3 and T5s, why they couldn't have them all the same, but I guess someone figured out they might as well confuse us even more and have different types of slips. But interest income, very, very simple. You buy a GIC, things like that. That's all interest income. That's line 10 there. Then some of you might have like involved in the real estate market and would have rental income. That's where the rental income stuff goes. This is the gross and the net. There's a separate schedule that you would have to complete for that. And again, that comes into income. If you're having it in your name, then you're adding it to whatever your employment income might be, would be the rental income. And that's where a lot of people get challenged when they're saying, "Oh, I love to have a lot of real estate," and a lot of people do really well on the rental and the real estate aspect, but they got to realize there's a tax payable on that. So that all comes into income and adds to your income, and again moves you up on the tax ladder, right? If we can call it that, the tax ladder. And then we move into capital gains. So capital gain, again, is derived from a particular investment, whether it's a real estate investment. I bought the house for 300. I sold the rental property for 600. I made 300,000 of capital gain. So basically, that type of income has to come and be reported as well. or you might have just investments, general investments. And these would be investments that are not in an RSP, not in a registered RSP, or not in a tax-free savings account, which we'll talk about those tools that you can use to shelter a lot of the taxes. And then some of us would have self-employment income. So this gets involved in like maybe have a little side business going, maybe some commission income that comes in that you're able to claim deductions against. A lot of you are farmers and stuff, so we'd have some farming income. I don't know if we have too many fishing income sources that people are involved with, but essentially, again, if it's in a personal nature, it's not set up in a separate entity like a corporation. You're adding that to whatever else income that you're going to have for that year. And that's going to define you basically at the bottom there with total income, that line 15,000 or 35 there, you can see that will be your total income for that particular tax year. Next slide. So from your total income, then we look in terms of deductions. So there's some direct deductions that are available, and that's on this page here. And really, two main ones that I like to always talk about, your RSP deduction there, line 20,800, line 38 there. So that's an automatic deduction. So if I put $1,000 in an RSP, I'll get $1,000 deduction from my total income. And that total income will then flush through down to your net and taxable income on the subsequent pages. Another thing that sometimes people have were annual dues or professional or like dues and stuff like that, union dues and stuff, and those are direct expenses as well. For those of you that have childcare expenses, I didn't highlight it, but 21,400, line 43, there'd be some childcare expenses. There's a separate schedule that you have to kind of float there. Some of the other things, moving expenses, if you had to move to get closer to your job, there are a lot of rules around that, but that becomes an expense for you. And just kind of looking down, and that's pretty much all I wanted to kind of cover off in terms of direct expenses that would bring you down to line 58 there to your net income. Next slide. So now net income then translates down to a taxable income. There's a number of things here before we get to taxable income. I'm not going to get involved in a lot of these. These have to do with non-capital losses and limited partnership losses and things like that. It gets more in the detail of investments and stuff. So capital gains deduction as well. So those get a little bit more detailed. But for most of us, we don't have anything in that section at all. So often the net income translates to the taxable income. So this is the important part. The taxable income is where your taxes are being calculated against, right? So looking at the tax rate, your taxable income, and you can see that in step 5 in the calculations, and you can see the different columns. And this is on the federal side. Remember, there's federal and provincial. So then 15%, 20%, 26, 29, 33%. You can see that on line 78 there. So essentially, each portion is out of that income is a portion to that, and then you pay the applicable taxes and the federal tax, and then the provincial tax will be calculated. Most of us would use a program or have someone prepare our tax returns. It's pretty straightforward nowadays. Doing your own tax return is not a bad thing. There's so many nice programs that are out there, and they even inquire or say, "Hey, are you missing this expense? Or are you missing that?" So it's very interactive, and I think helps in a lot of people not losing out on deductions and stuff. So, um, uh, just a quick story. I have a client and he's always prepared his tax return. And this particular year, he said there were so many slips and stuff like that. He's getting up on the ages as well. So all he did was just put everything together and then he put a note, Dear CRA, here's all my stuff. You figure out my taxes for me. So I've yet to hear back from him to see whether they did that, but I think that that's available. Probably not the best idea in the world because, A, it's going to take a while for CRA to actually prepare your tax return for you, and technically they don't. But there's always a chance that you're going to miss out on a particular deduction and stuff. So something to kind of look out for. So against the federal tax, just really quick, against the federal tax calculation, then in part B there is say non-refundable tax credits. So these are credits that will offset the federal tax and then ultimately give you your federal tax. And the same thing happens on the provincial side. So the non-refundable credits, the basic one, as you can see there, the basic personal credit is 15,705. So which tells us we can make up to 15,705 without paying any federal tax. Essentially, that's what it is. The first 15,705, we're not paying any taxes. And then there's all kinds of other ones that would be applicable as you get older. There's an age credit, there's a spousal credit if your spouse doesn't work, caregiver credits, disability credits, things like that that you would add in that section there. And ultimately, like I says, it would reduce the actual taxes payable. Next slide. Okay, so when we look at the taxes and the tax rate, so one main concept is I talked about the average tax rate. And again, that's a good guide for yourself in terms of where you're kind of sitting in terms of an average tax rate. So we also want to look at what's called a marginal tax rate. So it's that next dollar that you earn. What rate are you paying on that next dollar? And keep in mind, like again, we're on a tiered system. So the higher that income brought up, then you're into the next level. And so that next level is your marginal tax rate. And that's the top rate of taxes that you pay. So the goal or the strategy is A, how to stay within my level. Now, obviously, you're doing well and maybe extra commissions and things like that, that you want to go into the next level. There's no reason why you wouldn't want to go. You're just doing well, you're making more money. But from a tax point of view, how do I manage that? And the key thing, and I'll say it over and over again, that's still left with us in the Income Tax Act is the RSP deductions. So RSPs will lower you using at the marginal tax rate. So if you're at the marginal tax rate of 30%, then you put $1,000 in your RSP, you will save $300 on your income tax payable. It's as simple as that. So it's a very, very powerful tool because it hits you right at the marginal tax rate and helps you bring your overall taxes down. So that's a key thing to keep in mind. And of course, if your taxes are down, you're either going to get a refund or you're going to just pay less taxes because it all depends on everybody's circumstances. I've done tax returns for people before, and we've done significant RSP deductions just to get their rate down. And we might do a $20,000 RSP deduction, but they still owe 5,000. And when we look at the numbers, there's a reason why, because you can't completely get rid of that tax payable aspect, because it might have required $40,000 worth of RSP deduction. There is a point at which the rate of return on your RSP deduction diminishes. So we always try to kind of look at that and calculate. There's a point at which it's bringing me down on the level of taxes on the marginal tax rate. But then if I put more, it's going to bring me down, but at a lesser rate. So this is where a bit of the tax planning kind of works out. You want to kind of just stay at the top marginal rate. And then if you do still owe some money, then you owe it, but you know you've paid as little as possible anyways, and you've taken advantage of the reduction using the RSPs. Next slide. Okay, so then the other tool that's out there is the tax-free savings account. And so then this is a case more in terms of, okay, we have a bit of surplus money, so some people do, some people don't. I totally understand that. But sometimes the money's sitting in your bank account And A, it's sitting in the bank account doing absolutely nothing. Or B, you got a little bit of interest income, so you got a T5. And again, that adds into your income. So that's not a great thing either. Or C, like you buy a GIC, thinking, "Oh, okay, I want to keep it safe and stuff, so I'm just going to buy a GIC and make some interest on that and just kind of grow it that way." And it's in a non-registered environment. So the key thing that I want to kind of emphasize here is if I have surplus money and I'm in that situation, use the power of a tax-free savings account. So with the tax-free savings account, there are limits on how much you can put in. If you go online, I think the CRA system is down right now, just to let you know. But if you go online with My CRA, which I recommend everybody to sign up for My CRA, so they have access to their notice of assessments, all that stuff. It's not the easiest thing to get set up, but once you're set up, you'll love having it. But then you can see how much tax-free savings account room that you have because it's been accumulative since the program started. So right now, if you didn't have any make any contributions, I think we're up to 100 and 103, I think something. I got my list somewhere. So there's quite a bit of room. Even if you put in 5 grand to say I'm going to put 5 grand in the TFSA, maybe if I use it, I have to use it next year, that's okay. You can pull money out of the TFSA. There's no tax implications and stuff. But anything in the tax-free savings account will grow tax-free. And you can decide. It could be interest income, it could be capital gains, it could be dividends, whatever you want. You can kind of grow it and it doesn't hit your income tax return. I guess that's my point. It won't hit your income tax return at all. So this example here, I just want to talk about for those that don't want to use a tax-free savings account, which I don't understand why they wouldn't, but if they don't, or they've maxed out their tax-free savings account, which is the other side of the spectrum, that if you had still surplus cash and then basically saying, okay, I'm making $45,000 gross income, I'm single, my taxes payable roughly is about 5631 in taxes. So if I added $500 of additional income, and the type of income is very important if it's in a non-registered account. So it's not an RSP, it's not in a TFSA, it's in a non-registered account. So non-registered account could be an investment account, it could be just a savings account, could be just buying a GIC. So it's basically a slip, a T-slip is going to be created, and again, it's going to be added to your income. So if we took a look at $500 extra of interest income, for example, I bought a GIC and I got extra income from the GIC. So then it would go then from 5631 to 5731. So I'm paying an extra $100. So I made 500, but I'm paying an extra $100 net. I'm netting 400 bucks. Okay. So that I wanted to compare to something like investments that present dividends. And again, we're just looking at non-eligible, which are the majority of us would be getting non-eligible. So that's when, okay, I buy, oh, I don't know, I buy Toronto Dominion Bank, for example, as an investment, and they throw off a fantastic dividend and stuff. So those dividends are getting reinvested. I don't necessarily see the money, but at the end of the year, I get a T3 slip and it says so much dividends were issued to me. So if we use that $500 again, then my 5631 in taxes go to 5677. It's $46 more. So you see the big difference right away from interest income compared to dividend income. You've saved taxes there, right? And so more money in your pocket. That's the name of the game. And then further, if we looked at capital gains, and this is okay, I'm buying Nvidia and it's done well and I sold it and I made an extra, well, $500 is probably not enough, but let's say we made $500. Well, capital gains, and this is currently, you only pay taxes at 50% of the capital gain, which is really, really cool. Now, they wanted to change that all last year, and then they scrapped that whole idea. Hopefully, they'll keep it at the 50% tax rate inclusion. Although I do believe at some point in time, the government is going to eventually move that up to a 60 or 66% and maybe 75% inclusion rate. Only because that's an easy way for the government to make money is to reduce the tax savings from using capital gains. But then you can see capital gains of that $500 only represents $25 of extra taxes. So we've gone from $100 of extra taxes to $25 with the same 500. So again, more money in our pocket at the end of the day. So, moral of the story is rule one, use the TFSA for your surplus cash wherever possible. And then rule number two is when the TFSA is not available for whatever reason, look for capital gains or dividends, I think would be better strategies from a tax point of view. Next slide. Okay, so now we're getting into these non-refundable tax credits, which I didn't go into too much detail with because there are so many. So when they say non-refundable tax credit, basically they mean is that you need income to use these credits. If you have no income, you won't get any credits. So back in the day when I started doing tax returns, they didn't have non-refundable tax credits. They basically had tax credits. So someone that had very little income or no income actually got those credits and would see a refund. Well, of course, the government is saying, no, 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 we can't have that. And someone came up with this bright idea of developing this non-refundable tax credit concept. And so again, you have to have income to use these tax credits. So that's important to sort of note when you're doing a little bit of tax planning in terms of utilizing especially when you're looking at tax credits like disability tax credits and things like that, right? So two main ones I want to talk about is donations. So a lot of us do donations from time to time. We get people coming to the door, or you might have your favorite charity, your church, and things like that. Key thing, keep your receipts. So even that $20 or $5 you do when someone comes to the door, hang on to the receipt, put it in an envelope at the end of the year. Make sure you have that when you go to claim your income tax return because you would want to have that. You would want to claim it. I think that that's a key component that people often lose their receipts and then they're, estimating or guessing. And then often donations can be audited by the government. These are called desk audits. They're very, very simple. You'll get a notification to basically send all your donation receipts to them to prove those donations. And sometimes you're randomly picked. And so you want to make sure that you have your donations in place. There is a strategy with donations just to keep you in the loop. And this is sort of an incentive for the government to allow people to donate more. Is that up when there's a bit of a tax break? The more you donate, the more tax savings that you'll have. So up to about $249, you get about 15% tax break. Essentially between 250 to 500, then it ranges from 17 to 23%. So there's some significant tax breaks that, again, on a planning basis, if, for example, this year was a fantastic year, my commissions are up and this and that, or I have extra income, then consider, making donations to the places where you donate anyways, right? And it's going to help you. It's going to help the charitable foundation as well. The key thing with the donations, it has to be a registered charity. So there are a few things. I got caught a couple of times. People come into the door and they come in, they ask for a donation and stuff, and some of them are not registered charities. So that donation you technically can't claim. So the CRA has a website that you can check things. Most of the times on the receipt, they will have a registered charity number. And that tells you, and again, you have to confirm the number, but, especially these one-off ones that kind of hit you at the door and stuff. Another thing that I just wanted to mention is things like Princess Margaret often has that lottery, and I've known a couple of people that actually won, and so there is chances to win that thing, although you think it's kind of crazy. You can win these big houses and cars and stuff. But because if you buy the ticket is not a donation. So the $100 that you spend on the ticket is not an eligible donation because you're receiving something in return. You're receiving a chance to win something. So that's important to note. So Princess Margaret is a registered charity. You can donate directly to them. And sometimes I think, okay, I'm better off to use that $100 and just give it to Princess Margaret because it's probably better for me from a tax point of view as opposed to try to win this, house and cars and all this other stuff. But so keep that in mind when you're looking at donations. The other side of the coin is then medical and medical expenses. So again, any type of medical expenses, again, there is a whole sort of booklet on the different type of medical expenses that are eligible. Again, key thing, keep the receipts, make sure that you have them. Medical expenses basically can be accumulated for the whole year, but you don't have to use the calendar year. So keep that in mind. So sometimes, people might have a lot of medical expenses near the end of the year and then the beginning of the new year. So you can hold on to those receipts and claim them all in one tax year in order to accumulate them. Because as it says here, medical expenses, you get a deduction when you're 3% of higher above your three net income. So the first 3%, you can't, there's nothing to claim. But beyond that, so if you need to kind of move your receipts, as long as you end up in the tax year, then you can have any 12-month period. So keep that in mind. And the other part, the last part here is to combine it with a spouse. So you can combine expenses. So anything not covered, like for example, in our group plan, the portion that's not covered or something that's not covered at all, so would generally qualify as a medical expense. And you want to kind of hang on to those. See if you accumulate enough of those in order to make the claim as a non-refundable tax credit. Next slide. Oh, we missed my summary one. Oh, there we are. So final notes is key thing is take the time now. It's fresh in your mind. Review your 2024 tax returns. We're only midway through the year, not even quite midway through the year. So take a look at it, see if there's something that you can do in terms of planning, because that's the key is always sort of planning ahead. Look for some active changes that you can make, whether it's an RSP contribution or shifting some of the surplus money that we talked about. But the key thing, don't wait until the end of the year to sort of tax plan. It can become challenging at that point in time. You're scrambling, you're not too sure, and maybe you just don't do it. And then you end up in January, February, the new year, and sometimes that you can't do anything that will offset taxes for 2024 and stuff. So again, as part of sort of the group RSP plan and the Jocelyn team here, I'm happy to kind of have this conversation with people. I don't do tax returns, but I'm happy to have conversations about your taxes and look at some planning for you. But again, I wouldn't say it's a simple process, but sort of understanding the mechanism behind your taxes, I think, is a key component at this stage. And again, we're early enough in the year that we can still initiate some planning. And with that, we're into questions, if you have any.
I've got a technical one.
All right.
So we're in 2024 with a vehicle that was owned. Capital cost allowance has been deducted every year since the vehicle was new. And April 2024, the individual trades in the vehicle and leases a 2024 for the next 3 years. The question is is the person able to collect 100% of the capital cost allowance for the vehicle traded in for the year?
Yeah. Yeah, you were right. This is a technical question there, Romano, and stuff. So, all right. So I'll just kind of back step for everybody to kind of give them a little bit of technical definition. So the capital cost allowance, many of you would know what that is, but essentially you have an asset. So in this case, we have a vehicle. And as part of the Income Tax Act, you are allowed to depreciate that, and that's where capital cost allowance comes into play. So the value of the vehicle when you originally bought it was $50,000. Every year you're allowed to depreciate a certain percentage as dictated by the CRA. And then that brings it down to a certain value of undepreciated capital cost. So let's say you're down to 20,000 at that stage of the game. And then you now have sold that vehicle. So that's you've traded it in. So technically it's a disposition of that sale of that vehicle. So you've disposed of it. So then that may trigger a few things. Depending upon the trade-in value, may trigger a capital gain. It may trigger also a recapture of the depreciation. Because if the certain values don't match up, then you're actually depreciated it well below its actual value. So there might, and recapture depreciation is income to you. But long story short, then can I claim the capital cost allowance? Generally, it would be prorated for the period of time that you had it. So generally on your Income Tax Act, there would be, you would indicate I used it for 4 months and then I traded it in. So there would be a proration of the capital cost allowance. But I would more look at in terms of, do I need to depreciate it? Because ultimately there is a recapture aspect. If you use a tax program, generally it will calculate that all for you. You can indicate the vehicles being sold, and then it would calculate that for you.
Does that
Hmm.
apply to individuals or those who are self-employed and using the vehicle for business purposes?
Yeah, it would have to be business purposes. Yes. Good question. So yeah, on the us individually, no, there's no claim for our vehicle for any reason. You'd have to be in some form of a self-employment arrangement. Sometimes in the commission sales, although the commission sales, there are limitations on your deductibilities on stuff like that. But yes, for most part, it would be self-employed that you'd be able to claim any of that stuff.
Well, that really is not fair, Joe, because I'll give you this as an alternative. If two individuals became married on December the 31st of any given year, they are allowed to claim each other under personal deductions, basic deductions for each of them for the whole year if they got married on December the 31st. So I think that you should write to CRA and question them about this.
Who said that the government is fair? This
I
is,
have a, oh,
go ahead, Kevin.
there's a follow-up question to that. So if I can't claim the depreciation of a car I use as my just commute personal use vehicle, if I sold and actually made a profit, do I have to declare that profit as income?
Yeah. Yeah. So, great question. We're getting into like great technical questions. So that falls into the personal property regulations of the CRA. So technically, yes. Do people do it? No. So that's all I can tell you on that. But you're absolutely
Only
right.
fair
Yeah.
if you can't claim the depreciation, then you shouldn't have to pay the appreciation.
Again,
Yeah.
is CRA and our government fair? I'll let you
Oh
guys
no, of
decide
course not.
that. But yeah, yeah, good point. It was a good point. It even gets into things like jewelry and things like that, those are called personal properties. And there's a whole section in the Income Tax Act that talks about personal properties that, yeah, from a technical point of view, you needed to declare those things if you sold it at a profit. But I've never heard of anybody that does. Any other questions?
No.
Oh, there's something in the chat. Oh, no, someone left. Oh, Tracy left. Thanks, Tracy. Um, okay. So I guess we're done for our session. I hope you guys enjoyed that. Let it sink in. If you have questions, concerns, or whatever, you want to chat, fire me an email. Otherwise, we'll see you at the next session. Thanks, everybody, for joining.
See you, Joe.
Thanks, Joe.
Welcome.
Thank you.